What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. Good morning, Crispin. So you cover mortgage finance and asset managers at Piper Sandler, and certainly the mortgage finance space, which sits right at the intersection of interest rates, housing, credit, are really three factors that are obviously very important to the market and certainly our process. I'm curious, in your experience, what is some of the misconceptions investors have about the space today? And what's the most common question you're getting regarding your companies and the outlook?
Thanks for having me. And I think today or even just the last few weeks, but there's been a lot more interest in the space. You've seen mortgage rates move from 7% to roughly 6% today. And when I'm talking to a lot of investors, I'd say the biggest misconception is that companies can only do well in certain environments, where a lot of it is the rate of change rather than just the actual level of rates. So you look back to 2020, 2021, a lot of that time, there was about an 18-month period where mortgage rates were the lowest that they have been ever. Call it 275 to 350, somewhere in that range. And just the last few years, it's gotten much tougher, and you've had this headwind in mortgage, and you've seen origination volumes really come down. What you're starting to get now, and what you saw and what you're seeing and what you saw in 2025, is the mortgage market actually grew. So it's, even though mortgage rates started the year at 7%, they're going to ended the year called about 620 or so. You did see a 15% pickup in mortgage originations, and the market's roughly expecting a similar increase in 26 as well. So I think one of the major things is mortgage markets can grow when rates are 6%. They can absolutely grow when they're 3%. I guess one other misconception that I think is fair and I think worth digging into as we dig into the affordability, the administration, all that, is affordability, and then what the world looks like today and how it impacts purchase activity and refinance activity.
A quick question on the improvement, the acceleration you're talking about. Is that in nominal size, or is it in volume/transactions?
So it's in both, actually. So it's overall volumes. And what we've been seeing recently, it's a lot more on the refinance side. So if you're looking at refinance volumes today versus a year ago, you're up like roughly 100%. But what you're coming off an extremely low base of refinance volumes. So you still have a ways to go to get to, say, normalized levels, where if you're looking at 2026, like calling for about like 2.2 trillion in mortgage originations across the space. Roughly kind of 35% of that will be on the refinance side. But what you have is just the significant move. And if you just look at anyone who's gotten a mortgage in the last 2 years or so, that's the low-hanging fruit to get to refinance now.
Yeah.
But what you still haven't gotten to is on the purchase side, where people aren't really buying new homes in significant ways. And that's a lot of what the administration is trying to fix here. But it's more than just what mortgage rates are. It has to do with what's actual affordability, what is the cost of homes, and what does the supply picture look like.
So what kind of data can people follow, listeners of this podcast today, in terms of looking for purchase or refi activity?
Yeah, so the best data that we look at it, and we look at it definitely every month, and it usually comes out every month, is Fannie Mae has mortgage origination forecasts, and then the Mortgage Bankers Association. And they're both free data sets, and you can get them each month. And the way that we track it, and we do it in our mortgage housing monitor, is we look at, okay, what are the forecasts quarter by quarter? And then what are the annual forecasts? And then how have the forecasts changed month to month? And that's a good way to look at it. And there's a ton of seasonality as well, where typically you got first quarter, fourth quarter, much slower with mortgage originations activity, where you have holidays and then the start of the new year. And then you have what is called the spring, summer selling season. Recently, that's been flipped on its head a little bit just because of the move in rates. So you're going to get more refi activity. But those are the two data sources that we look at the most for that data.
So given that there are structural affordability issues, certainly in many places in the United States, that persist, and the volume of activity in existing home sales, the turnover in housing is nowhere near where it was certainly pre-COVID. How have you seen your companies adapt to try to recapture high profit margins in a lower nominal sales type of world? And I'm curious, we were talking before we started recording that you mentioned a company was using more AI tools. So I'm really curious to hear about that.
A couple of things in that, just how the mortgage environment has changed a lot in the past few years is, so the two key areas are mortgage origination and mortgage servicing. Mortgage origination is more of a gain on sale business. It's higher margin, and that's what the bread and butter of a Rocket. The other part of the business, servicing, it's a growing business. It's not as exciting as a business, but it's more the mortgage statement that you get monthly or it shows up in your email. That is what servicing is. And it's much lower margin, where a margin for a gain on sale for an origination could be 2.5%, 3.5% for a direct to consumer. But on the servicing side, you're looking at like 30 basis points.
Yeah.
So what you've seen over the last few years is companies have built these servicing portfolios. And in those areas, you want to be it's a much more scale business. And prior to Rocket's acquisition of Mr. Cooper, I covered Mr. Cooper, very large player in servicing. And then I also cover PFSI, also a very large player in servicing. So these companies over the last few years have been able to increase their servicing portfolios and have been able to actually perform well, generate mid-teens ROEs in what have been difficult mortgage environments because of that, essentially clipping the coupon on the servicing. And then on the technology side, this is something that companies have been investing in a lot for the last several years. And a lot of it's loan origination platforms, just to be able to make everything more automated. Just if you're applying for a mortgage, it's a ton of paperwork, a ton of input. And what we've started to see is just much greater efficiencies to be able to drive those times down on what the relationship is between the mortgage originator and the consumer.
So one more question to round out the housing credit side of things. You've talked about originations and refis. Can you speak a little bit about something that was very popular about 20 years ago, but has certainly gone by the wayside since GFC, which are home equity loans or HELOCs? Mm-hmm. So how does that fit into your coverage? And are you seeing anything changing, given that the Fed has been lowering rates for over a year, and that tends to be what a HELOC rate is measured against, or the bank's prime rate tends to play a huge role, which generally follows the Fed funds rate?
Yeah, exactly. No, and it's a good question. And for my companies, they're less involved in HELOCs, but more involved in closed-end seconds, which are home equity lines of credit. So the major difference between those are, let's think of a HELOC as a credit card for your home, where a closed-end second or a home equity line of credit is, okay, you have a $1 million house, you're going to get a $200,000 or $50,000, $100,000, whatever it is, home equity line of credit. For a home equity line of credit, you get that cash today, and then you're paying it down. The HELOC is different just because you have to tap it in order to kind of utilize that cash. So and a lot of my companies, they prefer the closed-end second route because it's much more predictable on the income stream, where sometimes people aren't tapping HELOCs, sometimes they are. And we've seen, just looking at data for both HELOC and closed-end seconds, you've seen a big pickup in the last year or last couple of years. And a lot of that is because of the environment we're in. If you refied your home or bought a home 2020, 2021, you have a 3.5% mortgage rate, and you have mortgage rates now sitting at a little bit over 6%, were 7% a little while earlier in 2025. You're essentially locked into your home. And so that's just the way that people have been able to tap the equity in their homes, either through closed-end seconds or HELOCs. So that's something that actually has gotten more popular. What you could see is if mortgage rates decrease further, if affordability gets better, you might see less on the HELOC closed-end second side, and you might actually start to see people moving and people purchasing homes rather than just refining.
So housing is an important part of our process. It's the beginning of the HOPE framework. So I definitely want to get a little bit into the outlook that you see and what you're hearing from companies in the space. But before we do that, I feel like we need to talk a little bit about the political backdrop. And what are your thoughts on current policies being discussed, implemented by the administration to stimulate housing activity and address the affordability crisis?
Have you ever spent as much time listening to politics for the purpose of better understanding your space and the risks around it?
I don't think so. And I've now pushed True Social posts, and probably 99% of them are noise, but I got to be on it for the one or two. And it was a couple of weeks ago, I was actually traveling. I was marketing in Florida, and it was the day that Trump put out the potential single family ban, and I'm going into meetings being asked about it. And it's literally driving between offices trying to get my hands around what's going on. So definitely looking at it more. And then I remember I was actually at the airport, I think a day or 2 days later, and that's when the $200 billion in agency MBS True Social post came across. Definitely interesting. It's definitely ramped up in just the last few weeks. But just stepping back a little bit, if you look at 2025, it was the start of Trump's administration, Bill Pulte being FHFA director, Scott Bessent. You've had an administration that's very focused on housing and mortgage. Not quite as much as the past few weeks, but they were definitely planting the seeds in 2025, where you had an administration that was talking about mortgage spreads, mortgage rates. You were having kind of talks about affordability, wanting to drive rates lower. And a lot of 2025, it was good to hear the commentary, but it was unclear, okay, what can they actually do?
No.
And it's the last few weeks that has turbocharged that. So just going through a couple of those that I think is worth hitting on, and feel free to stop me, ask questions along the way. But first is the potential single family ban from large investors that Trump posted on True Social, subsequently did the executive order. This is one where he is trying to limit, I cover Blackstone, so trying to limit Blackstone and some other large players in the space from buying homes. So when I think of large investors, I'm thinking investors that own 1,000 plus homes. And when you look at that group of investors as a whole, they're about 1% of the housing stock in the US. So it's very small. And I just don't think that this one is, first, you need congressional approval. And then I just don't think it's going to have major consequences if it does go through, just because of their overall size in the market. And then I also think that there could be unintended consequences where if we do go into a recession and home prices drop 10, 15, 20%, you will have lost a buyer of those homes if you don't have that large investor cohort.
Are there any regional concentrations for that large investor?
Yeah, so I would I'd say the Sun Belt is going to be a concentration, and that's something that has been out there where it's saying, okay, if you look at it as a whole, it's 1%, but then you look at it in specific areas, it can be much larger. And definitely understand that. And the company's argument to that is, okay, yes, that's true, but they are providing a good when you think of the affordability in the United States right now for housing. You have these large investors that are getting families into those homes. They're single family rentals. They're held by Blackstone and other investors out there. But because of the affordability issue, they're able to buy in bulk and then also rent out in bulk as well. The other focus that I think is more meaningful is the $200 billion in agency MBS buying from the GSEs. This was a few weeks ago that this was announced, and it immediately impacted agency spreads and mortgage rates. You saw almost overnight mortgage rates go from 6.15 to 6%. And this is meaningful. And when you think of the agency MBS market as a whole, it's a $9 trillion market. So 200 billion, not a major amount, but this is something that adds a non-economic buyer, which is super helpful to demand in that space. So driven rates lower. And then also, when I've been talking to investors over the past several weeks, if you're thinking about the single family ban, if you're thinking about the agency MBS buying, they think that this is just the start. This isn't the whole story, but you could see more. Does the 200 billion turn into 500 billion? Maybe. But then there's some other things that people are focused on. And just going into Davos, everyone was very focused on what Trump was going to say about housing because he teased it. And I think it was also the executive order for the single family ban came out the night before Davos. So you're thinking, okay, of course there's going to be some big splash, and of course, a lot of things to talk about and go through. So housing is just one small piece of that. But Davos was pretty underwhelming for housing with Trump's comments. So you didn't see much. I expected some big splash there, but there wasn't. But when I've been talking to people about, okay, everyone's asking what's next, what's the next driver for lower mortgage rates or better affordability, there's two key things that keep coming up. And that's lower guaranteed fees, or G fees. And these are fees that mortgage originators effectively pay Fannie and Freddie for guaranteeing mortgages. And these just get added on to your mortgage rate. So if you lower those G fees, it's a direct benefit to the mortgage rate. So that's something that is very tangible. The FHFA can take care of that and do that and directly take down mortgage rates. And the scope and the size, what you could do there, it could be 10 basis points, but you could do 15, 20, 25. I wouldn't expect anything more than that, but that's one key. And the other thought about this as well is, okay, so lowers mortgage rates, but it would actually hurt the profitability for Fannie and Freddie. But if lower mortgage rates are the goal, if better affordability is the goal, this is something that could make sense. Yeah. The second thing is just lower loan level price adjustments. So these are called LLPAs. And these are risk-based fees that get layered on a mortgage based on borrower and loan characteristics. Higher risk, higher LLPA. So think about, okay, lower FICO, higher LTV, higher debt to income, you're going to have higher LLPAs. So that's something that also can drive lower mortgage rates. So those are the two major other kind of policy actions that I think Trump could propose. There's other stuff out there like portable mortgages and 50-year mortgages. I view those as non-starters. I just don't think they really make sense, especially when you start doing the math on a 50-year mortgage of what that means for your monthly mortgage payment, and then if you look out the extra 20 years, what you're paying just doesn't make a whole lot of sense. But I think that the G fees and the LLPAs are possible and stuff that I'm sure the administration, the FHFA, that they're all looking at.
So on a typical mortgage today, how much do those fees in terms of basis points add up to? So what is that spread layered on? And maybe obviously it can't go to zero, but what's the base case there?
Yeah, so if you're looking at G fees, and it's not just a strict number, but you're looking at what could be 75 basis points right now. So not out of the realm to go to kind of 40, 50 basis points. It's possible. And you've had pre-GFC, you had lower G fees, but that would be the starting point. Then you can take it down. Yeah, like I said, you can take it down 5, 10, 15, but again, you're going to get the hit on profitability on the GSE. So it's, for any of these things, you have the intended consequences and then you have the unintended consequences. So you have to look at everything.
Do you think the MBS buying has a sustained impact on tightening up mortgage rates?
I've been covering the space for, call it the last the agency space for the last 5-6 years. And if you just look at the history of agency spreads, I think this is a good thing to look at before digging deep into your question, is if you look at pre-GFC, you had agency spreads, and I'm just using Fannie Freddie coupons to 10-year treasuries of, call it 80 to 100 basis points. And then you have GSE reform, you have conservatorship, and you saw, and then throughout, call it 2010 to 2020, you had QE, you had Fed buying, you had banks buying agency MBS in a big way. And then as QE went down, you had the Fed in runoff. You lost these non-economic buyers in the agency MBS market. So it turned into much more asset manager driven buying rather than the Fed that's going to buy at any spread. So my coverage of the names is you've had agency spreads primarily in the 140, then peaking out at about 200 basis points relative to treasuries. It wasn't that long ago, maybe a little bit more than a year ago, you had agency spreads at 200 basis points, a very wide margin for a implicitly government guaranteed asset relative to treasuries. And I never quite thought that you'd get back to 100 basis points. So I looked this morning at right around 80 basis points. Agency spreads are 80 basis points relative to treasuries. I think the trough over the last few weeks is right around 75. So part of how I think about it is I don't know how much more tightening can come, but I think what you can get is stability. And because one, you have the non-economic buyer of the GSEs, and just talking to this week, both AGNC and Analyst reported, and they're some of the largest agency MBS mortgage REITs out there. You're seeing banks start to come back. You're seeing foreign buyers involved. So there is this demand aspect that's positive, which I think that can keep spreads relatively stable at these somewhat tight levels. But even more importantly than that is when agency spreads were 200 basis points over, 180 basis points over, people were really worried about the ceiling for spreads. You saw widening and you didn't know how wide they were going to get. Right now, that's changed because of the administration, the FHFA, that is very focused on the mortgage environment. So that's not to say that spreads can't widen from 80 basis points to 120 basis points or 125, but you have a president, a treasury secretary, the FHFA, who's very focused on tighter agency spreads. So they're going to have things in their toolkit, and they've shown it already that they're willing and able to impact spreads and rates in that way. So I think the ceiling is lower now.
Yeah, it's funny because the beginning of the year, you heard a lot of technicians and even some strategists talk about how we're in a midterm year and how midterm years for the equity markets tend to struggle, if not go down in those first 9 months. But exactly with what you just said, we were arguing you could actually see an opposite upside improvement because everything that's Trump is doing, or mostly everything, is really aimed at helping all the affordability problems, whether it's through lower energy prices, lower home prices. When you think about consumer sentiment, it's probably their job, the price of gas, and maybe the affordability of their house that probably dominate what's driving that over time. And so we've got a long way to go before we can talk about being in a more normal environment for affordability. But regardless of what President Trump does, it's probably unlikely that it's going to resolve itself, certainly in entirety, just this year alone.
I agree with that.
So as we look ahead into 2026, Friday, we got an announcement of a new Fed chairperson. There's, as you said, probably more to come from the Trump administration on helping out housing affordability. We've got questions about the labor market. We've got the dollar whipping around. We've got interest rates in Japan that are volatile. So there's a lot of things to consider when trying to figure out the outlook for your industry, ultimately where rates are going. And fortunately, those spreads have come in, which have somewhat offset the backup in treasury yields we have seen year to date. So what's your general outlook? What's your base case? And what are a few of your favorite stock picks for this year?
Absolutely. So I'm definitely constructive on the kind of mortgage housing space for 2026. You've started to get some kind of better news, at least from the origination standpoint, in the last few weeks. And I think that you're going to have upside to a lot of the forecasts that are out there just on strict origination. So if we're looking at MBA data and Fannie data, you're looking at, call it 15% growth in 2026. And I think there's going to be upside to those levels. I think you're going to get benefits on the refi side. I think you could see purchase come through a little bit more, especially if mortgage rates break into the fives. And a lot of times it's the big markers where you can see more activity, where if you saw mortgage rates hit 575 or 550. But when I'm thinking about mortgage rates for the year, I'd say base case right now is, call it like 575 to 625. I think there's a good chance we stick around 6% for a while. I'd say rates probably went a little bit lower than I initially expected if I was looking at a 6 to 9 months ago. So I think we're in a pretty good spot right now to drive activity. And I think a lot of the mortgage forecasts out there they were updated in January, but I think they're still a little bit stale. I don't think they've quite priced in the environment. And also what I think you'll see is, I think you're going to see a very competitive environment on the mortgage originator side. We've started to see that in fourth quarter earnings, where originations are up in the fourth quarter, which is typically a seasonally slow quarter, but you're seeing gain on sale margins a little bit softer. So you have a little bit of a push and pull where you have mortgage originators out there buying for business. And then also on the market for 2026, I don't think it's going to be just mortgage rates sit at 6% today and stay there until December 31st. I think you're going to get some episodic moves with President Trump. If there's anything that we've learned over the past year and also in his first term, he can impact markets very quickly. And I think you could see some episodic moves, which isn't a bad thing for mortgage, where when you can see these companies make the most money is a lot of times it's when mortgage rates go from 650 to 6 back up to 650 rather than staying at 625 all along. Because you get this, in a way, almost a FOMO effect of, okay, if mortgage rates move, I have a 675 mortgage, they just hit 595, I'm going to save my $500 a month in my mortgage payment and I'm going to refi right now. So you're going to see that I think you're going to see volatility, but I think that you're going to see episodic moves. And I think that's something that will come to fruition in 2026. As I think about some of my favorite names in the space, I definitely the agency mortgage REITs, so that's AGNC and Annaly. And those are the two biggest agency MBS mortgage REITs out there. AGNC is just a pure play agency mortgage REIT, and then Annaly is a little bit more diversified. But that's a key way for, if you can't buy agency MBS directly, that's a way for retail to be involved. And
Yep.
I just think with the administration, with kind of where rates are, where spreads are, and the supportiveness, the support from the administration, they're definitely names that I don't think you want to be short. And I think you could have catalysts throughout the year. Some other names that I like that are in the mortgage space is Rhythm Capital, tickers RITM. So they are a mortgage originator, servicer, and they're also an asset manager. So they're diversified. Their new res mortgage platform is the number 3 servicer in the US, number 5 originator. And that's one that I like a lot going into 2026. It's one that hasn't benefited like some of the others going with the rally in mortgage rates. So it's one that I think that can get forgotten a little bit and is definitely worth a look. And then another name that I'd call out, and it's one that's having a very tough day today, is Penny Mac, PFSI. They reported last night they had a wide miss on more refi activity that they weren't able to recapture. And we've had to level set expectations. I think you have a new base for earnings. But when I think of Penny Mac over the next 12 months, I think the first quarter could be difficult, could bleed into the second quarter. But once you get to the second half of the year, I think it's one where you're going to say, okay, it looks a lot like it did a year prior, and you're going to have a little bit of this blip that was caused by MSR amortization, more refi activity that they weren't able to recapture, but you're going to get to a point where they're going to be able to drive high teens ROEs, and they're heavily investing into their kind of mortgage loan officers and the technology across their platform. So those are some of the names in the mortgage space that I like the most. All of them are a little bit different, but I think it's definitely going to be an exciting time in housing this year. And I think we're probably going to be getting some more news throughout the year.
Yeah, I bet it just feels every 3 or 4 months we get, like you said, these episodic moves in interest rates, whether they're up or down, and you get everyone running to one side of the boat, talking about a housing recovery or a short-term blip that's not going to last. So I agree. I believe we will be having these same conversations down the line, but hopefully the trend in interest rates, which has been coming down slowly, but it's been coming down since late 2023, continues and allows the economy to see its soft landing and some better housing data. That would certainly put the U.S. economy on broader footing, which is something we're certainly looking for this year. So thank you so much, Crispin, for all of your insights. We look forward to following your research as well as your stock picks, and we will certainly bring you back on in a few months, and I'm sure you'll have plenty of new content to talk about.
Thank you, Cantro, and thank you, Stephen. This was great.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.